Hello there. Welcome back to my channel. In this video, I want to look at the accounting equation. We have a question two that we want to look at. So the question two reads, analyze the following transactions and show the effect that each one has on the accounting equation. So we're given the first part is an example, which is e.g. Paid salaries via EFT 10,000 rands. So this is what we have in terms of our answer section. So we've got the first example that has been answered, and we have shown how to answer it. So in terms of the transactions that you are given on the example part, it reads paid salaries via EFT 10,000 rands. So remember, you have to first try to identify the double entry that is involved in the transaction given. So you see that in this transaction, in the example part, we have got salaries. So we have salaries account, and also we have what the salaries are being paid via EFT. And we know that the EFT represents the bank account. So we have got our salaries and our bank account. So a salary is an expense, and we know that all expenses are debited. So obviously, you're going to debit salaries, and EFT as bank account, you're supposed to credit it. Remember, whenever we are paying money, money is going out of the business, a bank is supposed to be credited. So basically, that's the narration that we have in terms of one section whereby we're saying account debited salaries. And then we check the account credited, which is bank. Then in terms of the effect on the account equation, we are saying salary is an expense, and all expenses reduces owner's equity. So it's a negative on the owner's equity part. And then all assets, when we credit an asset, it becomes a negative. So remember, when we credit an asset account, so we have a scenario we have like this whenever we have an asset account. So whenever we have an asset account, in this case, we have got bank account as an asset. We are saying when we debit, it's a plus on the account equation. When we credit, it becomes a negative. So in this case, we are crediting an asset in the form of a bank, as indicated here. And so we are showing it as a negative on assets. So basically, that's what we have. Then we go to the second part on the transaction of number 6, which is purchased invoice equipment, purchased office equipment, 10,000 rands from Daba, and paid using the banking application on the business cell phone. So basically, we see that the two accounts that are involved in this transaction is that we have got office equipment that was purchased. Remember, when we purchase a non-current asset, we don't call that purchases. We open the name of the non-current asset that we have bought. In this case, we've bought office equipment, so we're going to open an office equipment account, and also this equipment that was bought was paid via the bank, and as the banking application was used, so it's via bank. So we've got the equipment account and a bank account. So in terms of which one is going to be debited, which one is going to be credited, remember when we debit, we are supposed to debit what is coming into the business. Remember, we are purchasing office equipment, so we're supposed to debit office equipment, and then we are paying through bank. Money is going out, so we credit bank. So basically, these are the two accounts that we have in this case, whereby we have got already bank as pre-entered on the credit side. So on the debit side now we have got equipment. Then in terms of the effect on the account equation, equipment is a non-current asset, so it's an asset, so it's going to be adjusted in the asset column. Then bank is an asset again in the asset column. So basically, what we are going to say is we go back to the narration that we have, that when you debit an asset, it's a plus; when you credit, it's a minus. So in this case, by debiting equipment, it's going to be a plus. So we're going to say plus the amount that we have involved, which is 5,000. So it's a plus 5,000. And then by crediting bank as an asset again, it's going to be a minus 5,000. So basically that's what we have on that part. Then we go to the 12, on the 12, whereby we are saying merchandise costing 6,000 rands with a markup of 30% was sold to RR Rose on credit. So basically, we have got merchandise which have which was costing 6,000 rands. So basically, this is going to be the cost price. And then we have a markup that is given. So it means if you add the markup with the cost price, you're going to get the selling price. So we calculate the selling price. So remember the representation that we have in terms of proportion, which says if you say cost price, add your markup, you get your selling price. So we see that this is the case that we have according to the transaction that we are given, of which cost price is always represented as 100%. And we add the markup that we are given as a representation of 30%. And then the selling price in this case, in terms of proportions, percentages, is 130%. So basically, since we are given the percentage and then we are given the cost price, we can simply say the percentage times the cost price, whereby we say our percentage is 30%, so we're going to say 30 over 100 times or 6,000. So when you calculate it like that, you see that the answer that you're going to get is 1,800. So 1,800 is going to be the markup. So to get the selling price now, it means you are now saying selling price is equals to the cost price plus markup. So cost price, I will give it 6,000. Then you add your markup, which we've calculated as 1,800. And you get a final answer of 7,800 as a selling price. So we are going to have two double entries, double entry at cost price and then double entry at selling price. So this is our selling price. So at cost price, we are going to debit our cost of sales, and then we are going to credit our trading stock. That is the double entry at cost price, and we debit cost of sales, we credit our trading stock. So come here, we are saying we are going to debit cost of sales, and then we credit our trading stock. This is at a cost price, of which we are given the cost price is 6,000 rands. So that's what we have as 6,000 rands. And in terms of debiting cost of sales is an expense. It's supposed to reduce our owner's equity. So we're going to see a negative on owner's equity. Then by crediting our trading stock is an asset. So we credit an asset, it's also a negative. So we also have a negative 6,000 in the column for assets. Then we enter the second double entry, which is now at selling price, which are now recording the sales at selling price. So whenever we sell, we open a sales account, and the sales account is always accredited. So we credit sales, and then the corresponding entry is that we are selling on credit. So when you're selling on credit, it's supposed to be an account. We're supposed to enter in the account of debtors control. So we are crediting sales and debiting debtors control. So we come in, we credit sales, and then we debit debtors control. So this is the second double entry on the same transaction. So we are now entering using the selling price amount, which we've calculated to be 7,800. So in terms of debiting debtors control is an asset. So debit an asset is a plus. So it's going to be plus 7,800. And then our sales, when you credit it, sales they increase the owner's equity. So it is a plus again on owner's equity. So basically, this is what we have on the part of the counting equation. So thank you for listening, and hopefully the video was helpful.